Hi everyone, we are students from President University Group 5 and we will be presenting our final project titled Building a Strong Financial Future, focusing on financial management. Before we begin, allow me introduce our member group. First, Julie Leonora and me, Siti Rahma. Today, we will be analyze PT Financia. This company report current asset of 2 billion, current liability of 1 billion, net income or 1.2 billion, equity of 4 billion, sales of 6 billion, and cost of goods sold or COGS 4.2 billion. Our tasks today are to calculate the current ratio, return on equity, and gross profit margin. After that, we will interpret the company liquidity, profitability, and efficiency. Finally, we will benchmark PT Financia performance against industry standard, assuming an average industry ROA of 18%. How to calculate? The question is, how do we calculate the ratio? Again, the formula for the current ratio is current asset divided by current liabilities. Current ratio result with the available data. PT Financia current ratio is 2 billion divided by 1 billion, which result in 2.0. Okay, next, let's calculation the return on equity. The formula for return on equity is net income divided by equity. With the available data, PT Financia is return on equity is 1.2 billion divided by 4 billion, which result in 0.3 or 13%. Now, let's move on the gross profit margin. The formula is sales minus COGS divided by sales. Gross profit margin result with the figures from PT Financia. The gross profit margin is 6 billion minus 4.2 billion divided by 6 billion, which results is 0.3 or 13%.
Next, we're going to talk about the liquidity current ratio. As we know, PT Financia current ratio is 2.0. It means 2.0 is considered healthy. Maybe you're wondering, why is it classified as healthy? For the current ratio classification below, we can see healthy current ratio is above 1.0, neutral is 1.0, and below 1.0 is unhealthy. And for profitability, return on equity is 30% is higher than industry standard 18%. So it means it classified as excellent profitability. And also we have gross profit margin 13%. So it means PT Financia control it cost well. Maybe you guys wondering, how is it possible? Okay, let me show you. For the return on equity, we have healthy is above 15%, neutral is 10% to 15%, and unhealthy is below 10%. And for gross profit margin, it classified as healthy when above 13%, neutral is 15 to 13%, and unhealthy is below 15%. Next is the efficiency. Company seems to be working well, especially because of its high return on equity. Because of the high return on equity, the company is using asset effectively to make profit. Based on the number before, we can have conclusion PT Financia looks financially strong with good profit and have enough cash to pay bills. So the investor can put their trust on us by putting their money because it earns more than another companies. That's all for our explanation. Thank you.